Ankit is there, Emmanuel is there, right? Ankit?
Sir, sorry, I was on mute. Sorry, sir. I was on mute.
But you are there, right?
Oh, yeah, I'm there. I'm there, sir. You can see me on the video as well.
Okay, no, I just stopped that thing. Okay, we have here Emmanuel as well. Good. Okay, so statement of cash flows. Why do we prepare the statement of cash flows, Ankit?
So, statement of cash flow is very useful to know the current expenditure which are in the cash. So, basically, to calculate our current ratio, it helps us, and working capital, basically to know what is the status of our working capital. So, there are three subcategories. So, we divide it like cash from financing activities, cash from investing activities, and cash from operating activities.
Okay. But the question remains there. Why do we prepare cash flow statement? Okay, let's speak it like this. That there are several reasons for preparing your cash flow statement. Reason number one is that you want to see that how much cash do you have. Okay, so you can see from cash flow statement how much cash you have received, how much cash you have paid, and how much cash do you have at the end of the year. So it tells you that you have received this much, you have paid that much, and this is what you have got at the end of the year. This is one thing. But it's not very important to know that how much you have received or how much you have paid. What is more important is that where did you receive and where did you pay? You know, it's not important that how do you get the cash. For example, you've got $100,000 on your table. So that $100,000, it looks good, it looks nice. But more important thing is where did you get this money? If you tell me that I worked hard and I earned it, so I will say I will appreciate that. But possibly you would say that, you know, I sold my house and this is tax money. Or maybe another alternative that you said that I took a loan from the bank and this is 100,000 from there. So 100,000 is 100,000. There is nothing written on the cash where it came from. So we need to see that if we have got 100,000, did we earn it? Did we sold some assets or did we borrow it from the bank? So it's not very important to see only that how much you have. What is more important is where it came from. Do you understand the point? And therefore, we split the cash flow statement in three segments. We call it operating activities, investing activities, and financing activities, so that we clearly know that where the cash is coming in from and where the cash is going out to. So you said that one reason would be that I want to see how much I received and paid. Then you said move forward, and you said I want to see that where it came in and where it went to. And last of all, what will happen, which is also very, 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 very important, that your income statement will say that profit is $1 million. But then when you will see the balance sheet, the cash on the balance sheet will be $100,000. So now that doesn't make sense that I earned 1 million, but I've got only 100,000 in my hand. Where is the remaining 900,000? So cash flow statement will work as a reconciliation statement between the profit on the income statement and the cash on the balance sheet. Understand the point? Because when I will ask you, because when you prepare income statement is prepared on accrual basis. Accrual basis means that you record the transactions as soon as they incur. Something took place, you immediately record it into the income statement. You do not wait for the cash to come in, or you do not wait for the cash to go out. You just record it. So in your income statement, you say that my revenue is, you know, I don't know, 20 million. 10 million. So if your revenue is 10 million, it does not mean that all of the customers have paid. Probably some customers have still not yet paid and you have got receivable. Similarly, in your income statement, you never write down cash received or paid. You write down income and expenses. You write down salaries expense. But it does not mean that you have paid all that. You write down tax expense. But it does not mean that you have paid all that taxes. So income statement does not show you receipts or payments of cash. It only shows you, you know, expenses and incomes. You write down interest expense. I'm not sure you have paid or not. So income statement is prepared on the accrual basis, which means that there are always non-cash incomes and non-cash expenses within income statement. So your income statement, it includes non-cash income and non-cash expenses. And therefore, your profit, which is shown on the income statement, it is accrued profit. 1 million is accrued profit. So you come to me and you say my profit is 1 million and my cash is 100,000, and I say where is the remaining 900? And you will say that this 900, you know, $200 we purchased a non-current asset. Okay, so let's take it out. So then there is 700K, and you say 100,000 we decreased our liabilities from supply. Okay, that's gone. So now there is 600K. And you will say 600K, 300,000 is our inventories. We purchased some new inventories. So we take it out. So balance is 300 remaining from the difference. Where is that 300? And you say, you know, we returned the bank loan. We had a bank loan of 300, we just returned it. So that's how the profit of 1 million is justified against a cash of 100,000. This is the purpose of cash flow statement. So we start now. We say the purpose is the statement of cash flows. It shows the movement between a company's cash and cash equivalents at the beginning and end of the year. So we use the word cash and cash equivalent. Cash, we all understand what is cash. What is cash equivalent again?
Cash equivalent is something which can be easily converted into cash. So for example, if I'm holding a bill of exchange and it is having some dollar value which can be, you know, exchanged in terms of cash at the same point of time.
Okay.
So I treat it as a cash equivalent.
Yeah, cash equivalent is any financial asset which can be converted to cash readily, immediately, and at a known amount. So gold, is it cash equivalent? Gold can be sold very easily. You can sell gold within an hour. So is it cash equivalent?
I don't think, sir, we consider gold as a cash equivalent.
Why? Gold is not cash equivalent. You are right. The reason is that for being considered as cash equivalent, what is important is that its amount should be known. We said that at a predetermined amount, at a known amount. Gold prices, they change every day. So you cannot write down the value of gold as a cash equivalent because the value changes. If I talk about shares, if you have shares in some company, you can go and sell them in stock exchange anytime. So they are easily convertible to cash. But do we consider shares as cash equivalent?
No, sir.
Why?
Again, the price is not.
Again, the value is not known because the value changes all the time. So then gold is not cash equivalent and shares are not cash equivalent. Yes, bonds are cash equivalent because some of the bonds are cash equivalent, which can be converted immediately. And if there is a value, if there's a value, and if it is easily convertible. What else would be cash equivalent? Your bill of exchange, or probably if you have some bank cards, you know, your ATM card, the plastic card, it has some cash inside. That is cash equivalent because you can take it out anytime and you know how much you will get.
Yeah, bank draft also.
Yes. So differentiate between profit flows and cash flows. I always say a word. I say that profit is an opinion, cash is a reality. Cash is a fact, right? Profit is just an opinion. Why do I say opinion? Because profit is something which is on piece of paper, and profit is a function of the assumptions which you make while preparing financial statements. So profit can be, manipulated very easily. You just change the depreciation method of your assets, and your depreciation amount will change, and your profit can change. You change the life of the asset, your depreciation will change, and your profit can change. You can change your provisions. So profit is actually, which is coming from income statement, it is quite subjective. It is an opinion of you. So you prepare income statements. I also prepare income statement for the same company. It is possible that we come up with different numbers if we make different assumptions, if our accounting policies are different. But cash is a fact. If it is $100,000 on the table, everybody will count it as 100,000. Nobody will make it 99. And therefore, investors, owners, shareholders, they are very much interested in seeing the cash position, because you should remember that the survival of a business is with cash, not with profit. Of course, in the long run, we need profit. But please do not forget that the word bankruptcy, it means absence of cash. Bankruptcy does not mean absence of profit. You may make profit, and then go bankrupt. So you go bankrupt when you are unable to pay your liabilities, and therefore, cash is very important. It's just like the lifeblood of a business. So what we are going to discuss: statement of cash flows, IAS 7 standard, cash flow from operating activities, investing activities, financing activities. This first one, operating activities, you use two methods: direct and indirect method. Mostly we are using the indirect method. So three things you have: operating activities, investing activities, and financing activities. What is important is to understand what comes within operating. So let me go back and show you what comes within operating activities. So operating activities, they include your operating cash flows. Operating cash flow means revenue received. Listen, I'm not saying revenue. Revenue you write down in income statement. Here we talk about how much cash we have received from customers. And then your purchases does not mean that purchases in the income statement. Here you will say how much you have paid to suppliers, and then how much you have paid for other operating expenses. So you should remember that in cash flow statement, we only record the transactions which involve cash. Non-cash transactions have no place in our cash flow statement. What are the non-cash transactions? For example, depreciation, we don't write down. Revaluation, it's a non-cash thing. Bonus share, it's a non-cash thing. Accruals, non-cash thing. Provisions, non-cash things. So provisions, accruals, revaluations, impairments, they do not impact our cash flow statement. Anyways, the entire business activities, we divide them into three categories. We call it operating activity, investing activity, and financing activity. Within operating activity, revenue received from customers, cash paid to suppliers, and cash paid for other expenses. And last of all, taxes paid, interest paid, and dividend paid. You should remember these three things very carefully. Sorry. These three things you should remember: tax paid, interest paid, and dividend paid. So these are also your operating cash flow. Okay. Second category, which in within your cash flow statement, is called investing activities. Investing activities means buying and selling of non-current asset. You purchase a non-current asset, that's investment. You sell a non-current asset, you get cash. It is called cash inflow. So when you purchase a non-current asset, you call it cash outflow. When you sell a non-current asset, you call it cash inflow. Investing inflow. Investing outflow, investing inflow. Then buying and selling of shares in other entities. So you should remember here the word is other entities. When you buy shares in other entities, not your own entity. Because if you purchase shares in Alpha company, so why are you purchasing shares in Alpha company? You are making an investment. So that is investing activity. And when you purchase shares in Alpha entity, what will happen? That end of the year, you will receive something. And that something will be called dividend. So dividends will make your investing inflow. And when you buy shares, it is investing outflow. So dividend received. Please pay attention. Dividend received, you write down in investing activity. You have this thing before as well. Dividend paid. Dividend paid will go into your operating activity. And dividend received will come in your investing activity. And if you receive interest, that will also come in here. You invested some money, you are receiving some interest, that will also come in investing activity. Investing inflow, investing outflow. And last of all, you have financing. Financing means buying and selling of own shares. In investing, it is buying and selling of shares in other entities. In financing, it is your own activities. Taking or returning loans, principal amounts only. If you take loan or you return loan, that is your financing activity. You issue new shares. When you issue new shares, so it is financing, because you issue shares and you get finances, you get cash, you raise finance. If you take a loan from the bank, it's a financing activity. So you took $100,000 loan from the bank, it is financing inflow. End of the year, you return back 110,000. So you took 100,000, but you are returning 110. So this additional 10,000 is actually interest. So here in financing activity, you will only write down 100, which is the principal amount, and this $10, which is interest, that will go into operating activities. Okay. So it will come here in your financing, and the $10 which you pay as interest will go to your operating activities. Because interest paid, tax paid, dividend paid, like I show you here, interest paid, tax paid, dividend paid comes into operating. So statement of cash flows. First one is operating activities. You can use two different methods. For preparing your operating activities. One is called the direct method. The other one is called indirect method. Of course, the direct method is something which is very simple, easy. You will quickly do it in 5 minutes. Indirect method is a topic which will take more time. Indirect method is something which we use in exam, and this is which we use mostly in your practical life as well. So let's have a quick look on the direct method. So, but before I start this thing, direct method, let me explain you the concept in cash flow statement. That what happens that. Give me a minute, please. Let me set up. Okay, so how do you prepare cash flow statement? Now, if I ask you to make cash flow statement, how would you do that? What you need is that you need two balance sheets and one income statement. Like you come and say that, sir, please make cash flow statement for my business. So what I need from your side is give me income statement and balance sheet of the current year and the balance sheet of the last year. So I need two balance sheet, last year balance sheet and this year balance sheet, and plus I need this year income statement. So 3 papers you put on my table, you leave on my table, and after 1 hour, come and take your cash flow statement. Because you know what happens? The problem is that income statement, it tells me sales. revenue, but it does not tell me how much cash I received. Income statement, it tells me, interest expense, $10,000. Did I pay it or did I not pay it? There is no information from the income statement. Income statement does not tell me if we have paid that or not. In income statement, you write down, tax expense $20,000. But the question is that, did you pay that $20,000 or not? How much you have paid? So there is no information about cash received or cash paid from the income statement. Similarly, when you go and see the balance sheet, the problem with balance sheet is that balance sheet is only showing you the closing balances. Balance sheet says that you've got receivables 100,000, but that is the closing balance 100,000. How much you have received during the year, the balance sheet is silent on that issue. The balance sheet does not tell you. So independently, the balance sheet does not tell me anything. Balance sheet says closing balance, receivable is 100,000, but how much customers have paid, I don't know. It says that your tax liability is 5,000, but how much tax I have paid during the year, balance sheet does not speak about it. So individually, these financial statements, they do not communicate with you. But what you can do, that you can put them together. Like you will take two balance sheet, last year balance sheet and this year balance sheet, and plus this year income statement. So my current year income statement and balance sheet both, and the last year balance sheet. You take these three things on the table, and you can literally calculate all cash flows. I'm saying literally calculate every single cash flow in the business. Now, how do you do that? Let me show you. So current year income statement and current year and last year balance sheet. So two balance sheets, one income statement. So income statement, I just took some extra. Income statement says sales $100,000, purchases 60, interest expense 3, tax expense 7,000. It tells you sales are 100,000. But how much cash have you received from customers? It does not tell you. It just says that you sold goods for 100,000. Did customer really pay or not? Not sure. Let's see the balance sheet. Here you get 2-year balance sheet. Current year 2014 and last year 2013. Now you can find out how much cash you have received from customers. So who can tell me the answer? How much cash you received from customers? Can somebody take a try? Anybody, please? Ankit?
Yes, sir.
How much cash we have received from customers? How do you use these two financial statements? Ankit, let me tell you.
2,000.
You have received just 2,000.
We need to calculate the sum of both 2013 and 14. Then we see the movement.
That is what I'm asking you. Please tell me the movement.
So payables.
Okay, let me ask you like this. If I tell you that your receivables in 2013 were 10,000 and receivable in 2014 are again 10,000. Now can you tell me? You've got same receivable in 2 years. 10,000 receivable here, 10,000 receivable here. Like this. Now what do you see? How much cash we have received during the year?
No cash.
No cash? What about these sales $100,000 goods you sold? It means that you received $100,000 cash, my friend. Because it means that your receivables were 10,000 last year, 10,000 this year. I'm sorry, it is 10,000. 10,000 last year, 10,000 this year. So whatever you sold, you received all of that. Only that's why the receivables are same. Because you had 10,000 last year, 10,000 this year. So it means that all of this has been collected. But if I tell you that your cash in 2014 is 0, now what does that mean? It means that you received all of this plus all of this. So you receive $110,000 cash because your receivable becomes 0. So it means that your customers, they not only pay this 100,000, but they also paid this 10,000 from last year. And if I tell you that your receivables here are 15,000, so receivables are increasing. So receivables are increasing, which means that some of the customers did not pay. So I sold good 100,000 and some customers did not pay. That is why my receivables are increasing. So it means that I received less cash. That's why receivables are increasing, because I received less cash. So we received 95,000. We received 95,000 in this case. Let me show you how do you do that. You can say that your opening balance was 10,000 receivable plus sales. So 10,000 was my old receivable. 100,000 I sold goods new. So now my receivable should be 110,000. This is what my customer should pay me. But the balance sheet is showing only 12,000. So where is the remaining money? The remaining cash we have received. So opening balance plus purchases minus, opening balance plus sales minus closing balance. 98,000 you have received. If anybody does not understand, please stop me here. Understood? Aziz?
Yes, sir.
Okay. My next question is, what is the payment to suppliers? How much cash did you pay to suppliers? Aziz, you will tell me. Cash paid to suppliers.
6,000.
No. You've got 60,000 purchases as well to consider.
Okay.
Cash paid to suppliers. That's not really interesting. You people are slow. Maybe.
So actually, I didn't understand the complete picture. So these balances in balance sheet are YTD balance, right?
Yeah. Year-end balances.
Okay.
So 62,000.
62,000 we have paid to suppliers. Again, let's do it without formula. Let's do it without formula. Let's do it with the concept. Let me ask you. Your payables are decreasing, right? Payables are decreasing. It means that you make payment to suppliers, right?
Yes.
So how much you make payment from here?
2,000.
2,000. What about these purchases? 60,000. This you also pay to suppliers, right? Your opening liability. Listen, your opening liability was 8,000. Then you made purchases of 60,000. So now you should pay something like 8,000 was here and 60,000 is here. So 8,000 was your opening balance. 60,000 you made goods purchase new. So you should be paying 68,000. But your balance in the balance sheet is just 6,000. So where is the remaining 62 that you have paid? Should be very simple. Maybe I'm unable to explain.
No, sir. Fine. Yes.
Okay, so 8,000 was your opening liability, plus you made purchases for 60,000. So you should be paying now 68, but instead of 68, you only see 6 in the balance sheet. So where is the remaining that has been paid out? Next comes tax payable. Now, who will tell me tax payable? Suleiman, how much is the tax payable? Tax paid. So this is income tax expense. This is income tax liabilities. So you will make them together. Tax expense is 7,000 and liabilities are 6 and 5. So how much tax you paid during the year?
You have paid everything you owe.
No, income tax, I'm saying income tax.
Okay, income tax, interest expense, income tax.
No, not interest. I'm sorry. I'm for income tax expense.
Fine.
Your opening liability was 6,000. This is what you should have paid. So 6,000 was your tax liability. Plus this year tax expense is 7,000. So 7,000 comes further on your head. So now your total tax payable should be 13,000. But what do you see at the end of the year? You only see 5,000.
Yes.
So it means that 8,000 has been paid out. 8,000 paid. Clear?
Yes, sir.
Listen, if you will get any difficulty in this calculation, then we cannot move forward because cash flow statement is just based on these things. Then similarly, we have to do interest expense. Interest, nobody will speak except Ankit. Ankit is going to tell me how much interest expense. How much interest we paid? Interest paid.
5,000.
Sorry?
5,000.
Good. 5,000. 2,000 was previous liability. 3,000 comes on the top. So 5,000 should be my liability. I see 0. It means all has been paid. So this is your tax paid 8,000 and interest paid 5,000. Great. Good. Let's move forward. This is your cash flow statement using the direct method. I will be quick on that. You see how quick I am? It's finished. It's done. Okay. Let me explain it. This is your cash flow from, and please do not expect it a lot in exam. This is simple method, direct method. We do not expect it a lot. This first part is your operating activity. This is your investing activity. This is your financing activity. In operating activity, it says cash received from customers. Now 47,300. You know how to calculate it. You will take your opening receivable plus sales minus closing receivable. You can calculate this. Then cash paid to suppliers. Again, I will take my opening payables, liabilities, plus purchases minus closing payable, and you get cash paid to suppliers. Cash paid to and on behalf of employees, which means salaries and taxes which you paid for employees, and then interest paid. Again, interest paid, you will use the same formula just like in the previous slide we were doing. Opening interest liability plus this year interest expense minus last year interest minus this year interest payable. So you get your interest paid. Now, if you pay attention, cash received, cash paid, interest paid. In income statement, you don't write down interest paid. In income statement, you write down interest expense. Now, this is cash flow. In cash flow, you have to focus on what you actually pay. So you get an operating cash flow, which is minus $600. Not a very good picture because if your operating cash flow is minus, it means that you are not generating any cash from your activities. Anyways, let's move forward. Then comes cash flow from investing activities, which is 40,000 negative. It means that we purchase some non-current assets, and when we purchase non-current assets, we pay $40,000. So that is negative because it is cash outflow. You purchase something. Then comes cash flow from financing activities, proceeds from long-term loan. So you took a loan, and this is the cash which you received. Issue of ordinary shares, 50,000. Again, we got cash inflow. I call it financing inflow, and repayment of loan. Maybe you return back some loan, so that is your financing outflow. When you make a total of these three numbers, you get 104,000. So you have operating cash flow, which is negative. Then you have investing. Then you have your financing, and you make a total of these three numbers. It gives you 63,400. 63,400. It is not your closing cash. It is your increase in cash, which means that as a result of this year activities, my cash has increased by 63,400. So if you have opening cash, let's suppose that in your opening balance sheet, like 2013 and 2014. So if I say in 2013 my cash was $5,000, then here it should be 68,400 because 5,000 I had at the beginning of the year, and 63,000 I generated during the year, and the closing balance should be like this. So if you see your balance sheet, which shows you like this, that balance sheet has 5K here, 68,400 here, and your cash statement it shows you 63,400 here. So that it means that everything is in place, everything is normal. Now, what I want to just quickly say here that we are not doing interpretation of cash flow. This is not interpretation activity, but I just want to speak one word that when I see this thing, 600 negative, I'm not very happy. But you should not be getting your operating cash flow negative. Operating cash flow negative means that your activities, your operations are not generating sufficient cash to pay your salaries. You see, you have negative cash here. Your total cash is positive, but cash became positive because you took loan and because you issued shares. If you had not taken this loan, trust me, you would not have been able to pay your salaries. Actually, you are paying your salaries by taking loan when I see this cash flow statement. So this operating cash flow should never be negative. It should always be a positive number. If it is a negative number, it has two possible reasons. Either it is negative because you are not making enough profits, so you are in loss, and therefore cash in is less and cash out is more. When your cash out is more, it means you are in loss. So this could be one reason. Another reason could be that we are not in loss, we are making very good profits. It is just that we are not able to receive from our customers. Cash received from customer is low because customers are not paying good, and that's why we don't have cash here. So if you are not able to recover cash from customers, still it is not a good sign. Your customers are not paying money, and you will go and take loan to pay your salaries. Not a good sign of management. So this one should not be negative. This one, your investing activities, it is negative, and it should always be negative. For any growing business, it should be negative. Negative means that you are purchasing assets, and purchasing asset is not a bad thing because non-current assets, when you purchase, they will increase your income in the next year. Non-current assets, they improve your earning capacity. Non-current assets are earning assets. So if it is negative, it looks like that we purchase some equipment and we increase our capacity, and next year our profits will be more. So it is negative, it is good. If it becomes positive, if it had been a positive number, if this 40,000 had been a positive number, I would be worried. I don't want to see it positive. Being positive, if it comes positive, it means that we are selling our assets and we are receiving cash. So no business is, business, you don't make business to sell assets, When do you start selling assets of your business? It's not a good sign. So this is negative, and I'm okay with that. I'm happy. This I'm not happy. This also, I need to see that why did they take this money so much? Are they going to invest somewhere or not? So that is a little bit of interpretation touch onto the cash flow. So this was your, how to say, cash flow statement direct method. If you've got any question until now, please ask me. Should we start? Okay, good. So now we need to do the indirect method. But before we start indirect method, let's learn some very basic concept of this cash calculation. Oh, Ankit is not here. Let me wait for him. Okay, so Ankit, Aziz, Tamila, and Emmanuel. There's one is not yet here. Okay, so what basic concept is about cash calculation? So let's suppose that you've got sales 100, you've got cost of sales 50. So gross profit comes out to be 50, and then you have your admin expenses, distribution expenses, depreciation expenses, and net profit is 25. How much cash will you have from here? If you see that, you come in and you say, sir, this is the profit, net profit, and this is your $25 cash. Please take your cash and let me leave. So I'll say, okay, let's check the statement. What is the sales? You say, I sold goods to customers, and this is the money which we got from the customers. Fine, this is okay. What is cost of sales? This is we purchased materials, we paid it to the suppliers, and these are the receipts. And this $10, these are admin expenses, these are salaries. I already have paid it, and these are the payroll slips. And what are these distribution expenses? This is something we use some transportation, and these are the invoices, and we have already paid it. And then what is this depreciation? This is the depreciation expense for the equipment. And the question is that whom did you pay this? So you did not pay this money out. This $5 is subtracted from 50. So it was decreased from, or it was eliminated or deducted from your earnings, but you did not pay out. This cash is still within the business. It is not being paid out. So how much cash do you have now? Your cash should be more than 25, Your cash should be net profit 25 plus add back non-cash expenses. You should have $30 with you, right? Because this $5 you subtracted as an expense, you call it non-cash expense. You subtracted it as an expense, but in reality you did not pay anyone. So this should be within the business. So your business cash should be 25 plus 5 equals to 30. Make sense?
Yes, sir.
But then you go and you check and you see that, I had some non-cash income as well, which means that probably some of the customers did not pay. I have receivable. So your profit, your cash should be 27. Whether you do IS 7, you do direct method, you do indirect method, I don't care. Even if I do not know accounting, I can calculate my cash. My cash is basically, the concept is that whatever is my profit plus non-cash expenses means that expenses which I previously subtracted, but I did not pay them. So this was my non-cash expense. I subtracted this $5, but in reality I did not pay it. So this money should be within this there. This 25 was after deducting 5, but I did not pay it. So I should have 25 profit plus 5 this one. This should also be in the business. And minus $3. Minus $3 means that if there is any non-cash income. So you remember the rule. Your rule is that profit and add back non-cash expenses and subtract non-cash income. This is the concept which we are going to use in making your indirect method financial statement. Okay? Are you clear? Okay. So
Yes, sir.
let's move here. So non-cash expenses you add back because you previously subtracted from revenue, but you never paid them out and as cash. So cash is still in the business, therefore add it back. So now I'm going to make cash flow statement using indirect method. And if you remember, when we were using the direct method, let me go back. This was direct method. And I said that this part was operating activity, this was investing activity, this was financing activity. Investing and financing activity method is same for both methods. Whether you use direct method or indirect method, investing financing will remain same. The first method, the operating activity method, only this part will make a change, okay? So operating activity we have to prepare using a different method. So under indirect method, operating activity we prepare with a different form. We say that here, cash flow from operating activity, we start with net profit before taxation. Net profit before taxation. What does that mean? Which line you should take? Please allow me a minute. I want to write down something here. Let's suppose that you've got here sales, which is X dollar. Then you write down cost of sales, which is, and here you get gross profit. And then you write down admin expense, which is, again, in bracket, X dollar. You write down your distribution expenses. Let's suppose these are the only two, and you get PBIT. PBIT means profit before interest and taxes. After that, you write down your interest expense, and then you call it profit before tax, okay? Profit before tax. And then you write down your tax expense, and you call it profit after tax. So you've got here different types of profits. You have here, one is your CBIT. This is your profit before interest and taxes. One you have here profit before tax, and one you have here profit after tax. So three figures I have for profit. Profit before interest and taxes, profit before taxes, and profit after taxes. You will start here profit before taxation, the middle figure, this one. This line you will take. Profit before tax, which means after interest expense, but before tax expense. So let's suppose this number is written here like 3570. If you remember that, I was explaining in the very beginning of this topic when I was giving introduction today, that cash flow statement is kind of a reconciliation statement between the profit on the income statement and the balance of the cash on the balance sheet. Because I said that income statement will say profit is $1 million, but balance sheet will say cash is only 100,000. So where is that remaining 900,000? Because income statement says profit 1 million, balance sheet says I've got cash 100K. So the difference we have to find out, and this is what we said, that we will start with profit from the income statement and we will end at cash at the balance sheet. So I'm preparing a reconciliation statement between the profit on the income statement and cash on the balance sheet. So we will say that net profit before taxation 3570, this number, and above that thing, because you are starting from this point. So anything above, which is non-cash income and non-cash expense, you have to add subtract. Just like I told you in the previous slide, that you take profit, add back non-cash expense, subtract non-cash income. So I'm taking 3570. Maybe there are some expenses here which we have written here as non-cash expenses. We have subtracted them. In arriving at 3570, we subtracted them. Now we are going to add them back. That logic we are going to apply. So we'll say that add adjustments, add back depreciation. Just like in previous question, I said $5 depreciation, you add back 25 plus 5. So now I'm saying 3570 plus 450. If I have some depreciation, I add back. And then I say investment income. I subtract. Now, why do I subtract? Please, all of you are fully attentive. I need 100% of your attention. Is everybody fully attentive?
Yes.
Okay.
Yes,
now, investment income usually is where? Investment income usually is shown somewhere after gross profit. Here you have your investment income. Investment income is usually after gross profit. Okay. You made some investment and you made some income on that. You put it here. Now I'm subtracting it from here. Why do I subtract from here? Not because I don't receive cash. I'm not subtracting it because it's non-cash income. No. I'm subtracting it because this is investment income. I am making operating activities. So this cash 3570, it includes this 500 here. Investment income of 500 here. This 3570, it includes investment income, but investment income does not belong to my operating activity. It should be, it should be treated under investing part of the cash flow statement. That is why I'm taking it out. I say that 3570 is profit, but I take profit from here, and it includes this $500 of investment income, which should not be reflected under operating segment. I would write it down in investing segment, and that is why I make it a subtract. Okay, understood?
Yes, sir.
And then I say, interest expense I add back, because here, if you pay attention, that we are taking from cash profit before tax. So interest expense we already have subtracted. But it says interest expense. We do not know that if we have paid it or not. We do not know. We add it back. Like a non-cash expense, we add it back. So you get a number, which is, you get a number 3920. It is called operating profit before working capital changes. Now, let me tell you, please pay attention. Your operating part of cash flow statement is little long, but you can make it easy by dividing it into three parts: first segment, second segment, and third segment. This first segment, it may have 3 items, like I should write down, or it may have 4 items, or it may have 5 items, or it may have 6 items. I just put here three lines, but there could be 4, there could be 5. This is the most complex part. This is the most difficult part. I will come back and explain it again. But let me move forward and then I will come back. What happens? This is called operating profit before working capital changes, and then you have to make changes in working capital. Now, what is working capital? Working capital, you know that working capital is receivable, payables, and inventories. So working capital means receivable, payable, and inventory. So I will say that increase in trade receivables. Increase in trade receivables. Increase in trade receivable means what? You see what? You see, you will take two year balance sheet. 2013, 2014. Your receivables were 10,000. Now they have become 10,500. So when receivables are increasing, it means customers are not paying. And if customers are not paying, then we will have less cash, and therefore we subtract. This is the easiest thing to find out. Just take 2 year balance sheet. If receivables they go up, cash it goes down. So I subtract it. And then you will see for inventories, 2 years. You will see 2 years inventories. So if your inventories are going down, decrease in inventory, which means you sold inventories. If you are selling inventories, your cash will increase, and therefore you add it up. If it had been increase in inventory, like inventories are increasing, which means I'm purchasing inventories. If I'm purchasing goods, my cash will go down. So very simple. In 1 minute, you can see this number. Not even in 1 minute, you will take 10 seconds. Just compare two inventories. Inventories go up, cash go down. Inventories go down, cash go up. And then you see your payables. So that's also very simple. Decrease in payable. If payables are decreasing, it means I'm making payment to my suppliers. And if I'm paying to suppliers, my cash should be less. So payables go down, cash goes down. Payables go up. Payables are increasing, which means I'm not making payment to suppliers, which means my cash should be more. So these 3 items, these are called working capital, working capital changes, receivable, payable, inventories. Just pick up the 2 balance sheet. You don't need to make income statement here. Income statement you don't see, just 2 balance sheet, and the difference write down. Very easy. Yes, Ankit?
Yes, sir.
Okay. And then comes the third side of the transaction, cash flows. This operating part, the third segment. It has interest paid, tax paid, and dividend paid. Very simple. Interest, always 3 items: interest paid, tax paid, dividend paid. Interest paid, you can calculate, like I told you at the very beginning, 2 balance sheets and 1 income statement. Last year interest liability plus this year interest expense minus this year interest liabilities. So 2 year balance sheets, 1 year income statement. We just calculated for tax payable, if you remember. Do you remember, or should I go back and show you? We just did it here. 2 balance sheets, you see, tax paid, interest paid, opening interest liability plus this year interest expense minus this year liability. Tax paid, same way. Opening tax liability was 6,000. This year tax expense is 7,000. So my tax liability should be 6 last year plus 7 this year. Expense 7,000. 6 plus 7 is 13. But I don't see 13, I just see 5. Where is 8? 8 I have paid. So you will use this logic to find out interest paid, tax paid, and dividend paid. So these 3. Now, what I'm just trying to reinforce here, that this third section has strictly only 3 things: interest paid, tax paid, dividend paid, no 4th item. Not 2, not 4, all 3. This second middle section, it also has 3 things: receivable, payable, and inventories. So these are very much clear. There is no doubt, and we can calculate. Yes, this part is under question. Here, you may have 2 items, you may have 3 items, you may have 4 items, you may have 5 items, depending on the situation. But usually these are non-cash incomes, non-cash expenses. Okay, non-cash income, non-cash expenses I put here. Receivable, payable, inventory I put here. Tax paid, dividend paid, and interest paid here. So if you keep this structure in your mind, that would be easy for you. Okay. So this was the difficult side of your cash flow statement, the indirect method. Operating part was a little bit more complex. It is a little bit more long. Then comes your investing and financing segments. Okay, any question until here, please ask. Otherwise, I will move forward. If you want to ask something you don't understand, please ask here. Nothing?